Maybe stock valuations don't even matter anymore. Maybe it's just, that's old man stuff. That's, oh, look at my piece of hair. Look at that. That is funny. How did that thing get like that? Can I pull it out? Can I grab it? No, you just came in, baby. Finn's trying to go back. You just came in. All right, so the issue that we have to contend with, I did a video yesterday talking about how the next 10 years not to expect high rates of return. I think it's I use about 6% for stocks as gross of inflation with a 3 to 3.5% inflation. That gives us about a 2.5 to 3% net or real rate of return on stocks. This guy, dude, what a knucklehead. He just came in like 2 seconds ago. Just came in. Yeah, I'm looking at you. We saw another little puppy that looks kind of like Finney's little sister that Charlotte's like, we should get her. I was like, dude, we already got 2. We've already done our duty to God in his country, and God in our country by adopting 2 dogs. So you can't have another one, even though it was a cute little girl. A puppy baby just looked just like Finney. Anyway. So somebody, like one guy said, I think it's Bill, he's like, Josh, well, I got 23% up last year. I said, dude, no one... I said, these projections are for 10 years. The average is over 10 years there, guy. Well, I got 25% last year, so you're wrong. Anyway, and I'm actually a little bit more conservative than Vanguard, as a matter of fact. But anyway, it doesn't matter. So the issue is, how do we get stock returns? Well, it's earnings growth plus dividend yields, all right, plus or minus price to earnings growth, expansion, or price to earnings decline, contraction. Price to earnings are what's called valuations. How much are you willing to pay for $1 of earnings? All right. Now, historically, the S&P 500, the PE ratio has been about 15.5 to 16, going back to the 1800s. But the drawback with the historic year-over-year average is that we come across a quarter like it's in Q1 of 2020 during the beginning of the pandemic, all right? When the prices just they bottomed out. Remember that? I call it the Valentine's Day massacre, because it wasn't just Valentine's Day, but it was around that time of year. The prices bottomed out. It's crazy. But the earnings hadn't been reported yet. So you're seeing all these PE ratios like just down in the gutter, like 7 and 6 and all this. And I'm like, well, this isn't reflective of the earnings, because the earnings have yet to be reported. I'll never forget that. And so what this guy named Robert Shiller from Yale, he won the Nobel Prize. Wow. I mean, I actually like Shiller, but this whole thing, he's a Nobel laureate. I was like, oh, it's kind of like the Pope. The Pope is chosen from God. I was like, because the bishops voted on him? Yeah, just because he's a Nobel laureate doesn't mean crap. I mean, doesn't mean he's stupid. Just, come on, man. That doesn't mean he's got more brains than freaking this guy right here. Old Betsy. Oh, I got to do like, look at old Betsy. Hi. Watch this. Pick. Got to pick the nose. Tickle. And that Pablo wants to come up here. All right. We are just all over the place here. You want to pick Betsy's nose there? Oh, you can't do it. You made me feel like dancing, 'cause dancing not away. You made me feel like romancing. Don't care what you say. Look at Pablo's teeth. Look at that. He's got the worst teeth ever. All right, so price to earnings contraction or expansion. All right, now the issue is, let me show you what I'm talking about. The current so anyway, I was going to say Robert Shiller, he did this thing called the CAPE, the cyclically adjusted PE ratio. So instead of looking at it quarter by quarter, because it's the quarterly or yearly price to earnings ratio isn't intuitive in terms of like any kind of like normal behavior, if that makes sense. And Q1 of 2020 is a perfect example of that. It's just not. So what Shiller did is like, let's level it out, have a levelized PE ratio. We call it the CAPE, cyclically adjusted for inflation, and we're going to stretch that over 10 years to get essentially an average of the last 10 years of PE ratios. He did that because in 2007 or 8, I can't remember what it was, but I think it was like 2007 or 8. He said, wait, the exact same thing is happening what I'm telling you right now. And so he designed this CAPE PE ratio. And what you see here's the average going back to 1871, right about, that's about 19 or so. And you can see is well below average from 1910 to basically 2000 and 1990 essentially. Had a couple years, 1929, that was right before the war right there, 1966. Then we had this huge drop off from 66 to 82, where the markets weren't doing anything. You say, I'm look at that. But yet the earnings were still growing. But here we had this massive run. And that's when Shiller first published his book, Irrational Exuberance, right around the same time as the drop. And everyone and their mom said, Shiller, you called it, even though he'd been working on his book for 2 to 3 years prior. All right, so what you'll see here is this is from my man Ben Carlson from I think Ritholtz Wealth Management. Ritholtz Wealth Management, and I like Ben Carlson. I'm not the biggest fan of Barry Ritholtz and those guys. I'm not against them. I don't know. I just not the biggest fan of them, and that doesn't mean I hold them in disdain or anything. But I just generally I like this guy. Let's put it this way. That's all I'm going to say about that. There's nothing personal. They rub me wrong. There's no other way around it. There's nothing, again, a little bit too New Yorkish for me, if that makes sense. Look, I'm just a caveman from an island off the coast of Maine. Look at that guy. Oh boy. And I don't like your New York ways and your BMWs and your phones that you can call from your car. I don't like that. Where I came from, we had a party line. You dialed 5 digits. On Peaks Island, 766-2704 or 2704 is my number. So you didn't have to dial 766. You just dialed 62704. If a lady was on the phone, you say, "Hey, Miss Smith, can I use the phone?" She goes, "Well, excuse me, but I'm talking. I got on here. I want to talk to Bertha." It's like, oh, okay. So when you call anybody on Peaks Island, you just dial 62704. If you called into Portland, I think you did have to dial 775. I can't remember what the actual number was for Portland. I forgot now. But anyway, yeah, I think you did have to dial the 7 digits. So if you just called in Peaks Island, you only had to dial 5. That's how old I am. And how rural I was growing up. We had chickens, by the way, back then. We had chickens, dudes. Your old buddy Josh had chickens. Then our next door neighbor's dog ate a couple of our chickens, and my dad was pissed. He was mad. All right, anyway, so going back to Shiller, what we'll see here is we see the average CAPE going back to 1871 is 17.4. All right, so there you go, 17.4 for the previous 10 years of inflation-adjusted earnings for the stock market. And you can see we're well above that right now. We're at 30.8. So we'll just say 31 for simplicity. So we're almost double the average. And you can see since 1990, as Ben Carlson says, he says we haven't been below average only one time, really, right here, since 1990. And so basically, if you would have waited for the PE ratio to fall below average, you would have missed it there, and you would have been waiting forever. Now, this is what I like about CAPE is because you'll see right here, that's what happened in 2020, like I was just talking about. But because we stretched the PE ratios out over 10 years as opposed to just one quarter, it never went where, down here where it could have been if we did it for a quarter over quarter, which you don't want to do. Anyway, so we're talking 150 years of data. And I want to keep going to you. And since 2010, there hasn't been a single monthly reading that's below average. Since 2010, it's been above average ever since 2010. In fact, there hasn't been a single monthly reading below 19.6. And that was right there in the pandemic. Actually, that wasn't right there. Right there. Even during the pandemic. Look at that. Still above 25. All right. And in 2009, you didn't get a chance to buy when valuations are below average. All right. As early as 2010, people were already sounding the alarm bells about valuations being too high. And here's old Henry Blodgett. You all remember him, Henry Blodgett? He got banned from the markets because of the 2000 shenanigans. Right here, U.S. stocks are now more than 30% overvalued at 21 times earnings. That's more reasonable than the 100% overvaluation in 2000, as you can see right here. But he's talking right in there, right there. But it's closing in on the level of the 3 other bubble peaks of 1901, 1929, and 1966. So he's talking about right here, right there, and right there. And he was right. It was closing in on the bubble peaks of these years, if you want to call those bubble peaks. Hi. Oh, okay. I'll say hello to everybody. Yep, there he is. He wasn't alone. It's funny looking back on low interest rate period of the 2010s because it seems like such a layup that stocks would take off in such a scenario. Well, no one knew there were going to be low interest rates at that point, Ben, that they'd stick. No one knew in 2010 the interest rates would stick that low for that long time. But at that time, people were saying those low rates of return of interest were going to be the cause for low return because everything was priced at 10-year. I cannot agree with that more, 100%. The earnings risk premium. If you only get 3 on your interest rate on the 10-year Treasury, you had a 4% earnings risk premium, you get 7%. Don't look at stocks that way. You look at stock potential for earnings growth plus dividend yields. That's it. Don't give yourself an earnings risk premium or equity risk premium, ERP, above the current 10-year Treasury. That's what people do. It's just wrong. Again, as I said a couple weeks ago, James Glassman had a book, Dow 36,000. He wrote that in 1999, just before the market just fell off a cliff. And like 6 months later, what's his name? Shiller wrote his book, Irrational Exuberance. And so everyone looked at Shiller as a man and James Glassman as a fool. No, we have got close to 36,000 on the Dow. Just took 23 more years than expected. All right, so right here. And the Fed was going to cause hyperinflation, not a bull market in stocks. Dude, everyone thought. I completely agree. I used to say that too. And we're just wrong. We were just wrong. Everybody was wrong. Remember PIMCO's new normal of low rates, low growth, and low financial returns? Well, we did have low rates and low growth. And then Bob says, I sat through countless presentations in the early part of the last decade. You can see I was looking for some old T-shirts right here. If you're wondering what these are, I was just looking for some old T-shirts. All right, there. I sat through, let me see right here. I sat through countless presentations of the early part of the last decade from professional investors telling me that U.S. stocks are in the 97th percentile of historical norms, that we should expect much lower returns going forward. All right, but yet this is what happened. The U.S. stock market has been overvalued 95% since 1990, and it's up more than 10% a year in that time. Look at that, from 1990. Buddy, make up your mind. All right, there we go. You can see from 1990 to here, the market is 2.4 thousand%. 244,000 has increased, averaging 10% a year since 1990. It's nuts. And yet the market has been 95% overvalued of the Cape, has been overvalued 95% of the time, and yet it still went up. In the 2010s, the S&P 500 did nearly 14% a year returns, despite people shouting how overvalued it was. And again, in 2010, we see right here, and we see it's just gone up ever since. That's the PE expansion I've been talking about. I did the video on that yesterday, the PE expansion. You cannot blame people for expanding the price-to-earnings ratio when interest rates are so low. That's what I'm trying to say. Now that interest rates aren't so low, are you going to still get the same PE expansion? If not, then how are you going to get your returns? Earnings growth? I mean, again, that's what it comes down to. If you're not going to get the same PE expansion as we had from these years, why do we have the PE expansion from the years? Because the interest rates are so low. If you're not going to have low interest rates, and you're not going to, thus you're probably not going to get PE expansion, and PE is already high at 31 roughly for the Cape, and just regular PE is still pretty high, not extraordinarily high. But if you're not going to get the PE expansion, then and the dividend yield is 1.5, how are you going to get stock market returns? Where does it come from? And the interest rates are competitive now. There's only one place for it to come from: earnings growth. Well, how does earnings growth when we look from 1950 to 2023, the earnings growth net of inflation is 2.6. We look at the last, I think it was the last 10 years. It was the last 10 years. Earnings growth was 4.5. So the earnings growth year over year over the last 10 years was double that it has been since 1950. Can we double that again? I highly suspect we can't. Where did the earnings growth come from? A lot of it came from stock buybacks. Earnings per share. You reduce the amount of shares outstanding, inherently you have higher earnings growth. That's just a fact, which increases, as we see, with lower interest rates, we increase our PE ratios too. Anyway, so where is it going to come from? I just don't know. I mean, maybe we could have PE expansion. I don't think so, but let's see. These are not valuations that scream in buy levels, just below. Oh, he's talking about 1990. Okay, right here. There was a 12-month period of below average multiples in 1990 and 1991. Valuations didn't go below the long term until a 10-month period late in 2008. That's crazy. That's just crazy. So anyway, let's keep going here. In the 2020s, a decade which we've experienced a pandemic, 40-year high inflation, 2 bear markets, one of the most aggressive Fed hiking cycles in history, the S&P 500 is up more than 11% a year. I know what you're thinking. Ben, You haven't read this paper to show how important valuations are. Now, I probably read it. I know the data. I'm not saying this will continue. I'm not naive. At some point, higher than average returns will lead to lower than average returns. I completely 100% agree with that. That's how long-term averages work. My point here is in the investment community, we probably pay way too much to valuations. Understanding market history is absolutely a prerequisite when it comes to investing success, but becoming a slave to the data becomes a liability. Anyway, maybe. The last 15 years of U.S. stock market returns are a wonderful example of how hard it is to predict what's going to happen next. Yeah, I completely agree with that. Sure, no one could have known that the Fed would keep the rates at zero for so long. Yeah, I think valuations matter. I do. I think price to earnings ratios, and the reason valuations matter is because you're going to value a stock relative to your alternative investments. If your alternative investments are freaking not of value, i.e. they're not getting any reward for the risk in terms of locking up your money in a low interest rate investment, you're gonna say, I'll pay a high. It's like real estate, dude. You say, look, the real estate market is higher than I like, but my other investments are what? Are lower than I like, so I'll pay a premium for real estate. I'll pay a premium for stocks because everything else it's not even keeping up with inflation. So I think valuations do matter, and I think valuations are going to play a role in what we look for the next 10 years. How else can you justify it? And I'd love to hear your thoughts. People say, like this guy, Bill, I said, he's like, oh my goodness, I got 25%. Okay, in 1 year. What do you think you're going to get the next 10? And then don't just say what you think. How? How do you get those returns? How? The only way I can see is earnings growth increasing significantly. And then I'd like to know how. Battery technology. It was always about technology that's yet to come to fruition. AI. I mean, come on, man. All right. I'd love your thoughts. I'm not a pessimist. I'd take a 4% net rate of return, net of inflation. I'll take that any day of the week. Do I expect it to happen? No. Yes, I expect that to happen, but I don't expect 7 or 8%. I'll tell you that right now. And I don't think you should either. All right. Love your thoughts. See you.